David R. Guttery is the president of Keystone Financial Services in Trussville, Alabama. David Guttery is a financial advisor who represents Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by David Guttery, president of Keystone Financial Group here in Trussville, to share his thoughts about the markets at the end of the year and opinions about what the new year may bring. David, thanks so much for joining us. So, within your last two videos, you laid out a case for why the Federal Reserve might indicate a willingness to slow down, and indeed that seems to be happening. So at the end of the year, what are your thoughts about where we've been in 2022 and what might be in store for 2023?
I believe that one of the biggest factors that contributed to volatility this year was the tendency for global markets to become short-sighted. Over a year ago, Chairman Powell and Treasury Secretary Yellen suggested that inflation was transient. Well, in my mind, this implies that inflation will be short-lived. Simultaneously, we heard the Federal Reserve beginning to offer thoughts pertaining to tapering and ultimately tightening. I believe that markets largely discounted the impact of tightening. Because after all, if inflation is transient, you can easily make the assumption that tightening, in an effort to control that inflation, would also be relatively mild. In March of this year, when the Federal Reserve laid out a schedule for predetermined increases to the discount rate and also indicated the degree by which it would begin to unwind its balance sheet, I believe this shocked the markets. Very quickly, markets moved away from considering the next 30 months to considering the next 30 days before the next Fed meeting. Within my last two videos, I suggested that the Federal Reserve was very aware of the impact that tightening was having on the economy, and that it was my belief that the Federal Reserve wished to avoid being a catalyst for stagflation. In this chart, out of the four possible economic outcomes, it would appear that the overwhelming majority of responses received from economists in this survey indicated the belief that we would indeed find ourselves in a stagflation environment.
David, can you help our viewers understand how global markets may have been left with the impression that central banks might be oblivious to the economic impact of their actions?
Yes. When a schedule for tightening is offered early in the year, the assumption is that such a schedule will be followed in a scripted manner without deviation. Frankly, who can blame the markets for coming to that conclusion when over 90% of the world's central banks are seemingly doing the same thing in tandem? It leaves you with the impression that economic declines may accelerate and result in a period of stagflation rather than the soft landing about which we've heard so much. Now, I've spoken before about how unusual it is to see the Federal Reserve tightening while the economy is contracting anyway. It is even more unusual when these patterns of tightening are more restrictive than we have observed in any other period of time over the last 35 years. Furthermore, as late as last week, Chairman Powell once again reiterated that the target of the Federal Reserve was to achieve a personal consumption expenditures price index level of 2%. Well, clearly we remain far away from that target. When markets become short-sighted and fixated on a period of days rather than a period of months or years, it becomes increasingly easy to overprice risk into current assumptions. I believe that this was the theme of 2022, and as I described in my previous videos, I am encouraged that we are finally beginning to see evidence that suggests markets may once again be considering what could happen over the long run instead of next week.
David, you recently celebrated your 31st year in practice. Reflect over those 3 decades and describe to our viewers how unusual this year has been in your view.
Certainly. This has truly been a year of firsts. The Federal Reserve is trying to regain control over a monster of money that was printed during a 30-month period of time so that it could be the single largest central purchaser of Treasury securities as the Congress promulgated new measures of spending to support an economy that had shut down for the first time in history over a disease that no one had heard of prior to 2019. The Federal Reserve has only begun to unwind its balance sheet, As a precedent-setting amount of money was printed, it was used to purchase these Treasury securities as the country went more deeply into debt, to fund such things as 2 CARES Acts, a Secure Act, an infrastructure bill, and a myriad of other initiatives designed to bridge the economic shutdown and recovery. Speaking of unprecedented amounts of money, I have drawn reference to this graphic on several occasions throughout the year. Clearly, we have never seen the M2 money supply at these levels, and this is creating a unique problem for the Federal Reserve, which requires a unique solution. There is a glut of U.S. Treasury debt on the open global market right now, and as the Federal Reserve continues to unwind its balance sheet in the billions of dollars per month, throughout the year, prices of these Treasury securities have plummeted and yields have risen sharply. This has resulted in a period of time where fixed income and equities are positively correlated, meaning prices are moving in the same direction and seemingly in lockstep for the first time since 1972. I was 3 years old the last time we had a phenomenon like this. This has resulted in Treasury yield curves that are more inverted since 1981. I was in the 6th grade the last time we observed such an inversion. As for the consumer, clearly indications of confidence are also at a very low point as income continues to increase at a declining rate, while we have inflation that we haven't seen at these levels since 1980. I'm not sure what your viewers were doing in 1960, but in October, the University of Michigan Consumer Sentiment Survey indicated the lowest reading ever recorded since the inception of the metric in 1960. So again, staying with the consumer for a moment, it is also disheartening to see that the average household in the United States is in more revolving debt right now than at any other point in the history of observing this metric. Look, these are just a few examples that I can offer to indicate how unusually strange this year has been. It's required a very deliberate and tactical approach to the management of money in this environment. Throughout the year, I have suggested that within an environment such as this, it would be best to give deference to areas where demand was likely to be durable and avoid discretionary areas where demand is likely to be variable. To illustrate this point, I have suggested to clients over the last 30 days that they have likely used a razor blade, touched a bar of soap, turned on their lights, eaten something, used a paper towel, put gasoline in their car, paid a health insurance premium, and made a mortgage payment. If you had a headache, you likely took an ibuprofen or a Tylenol. Well, there are 6 sectors of the economy right there. The point being, you will take whatever is left of your income after taxes and inflation and continue to consume the things that you need. The only question is how many fewer cups of that $9 cup of designer coffee are you not going to consume this month? Indeed, through November, this approach seems to have worked well this year. According to Standard & Poor's, staples, energy, and utilities were the only 3 sectors of the economy showing a positive result through the end of November.
David, what are your thoughts for the coming year, and what advice would you have for our viewers?
I would suggest that the key now is to monitor the Federal Reserve and hopefully see their conviction to pursue targets of tightening in a much less hawkish manner. Should that be the case, then I believe that markets will be encouraged to return to normalcy as it pertains to discounting risks over longer periods of time. I believe that the Federal Reserve had to act quickly while the window was open and in a unique way to address a precedent-setting inflationary threat. My hope is that the first phase of this effort is behind us, and continuing toward long-term inflationary targets can occur with less disruption to the economy and assumptions made by capital markets. So in conclusion, regardless of the period of time or the state of the economy, the achievement of long-term goals is predicate on the consistency with which the implementation of the strategy is met. The composition of the investments accounts will change to reflect current periods of time, but the approach and the dedication and the commitment to the strategy should be unwavering. Even missing a few years with the thought of letting a volatile period of time come and go can have a detrimental impact 40 years down the road on the potential success of these long-term plans. So I get it, and I know that everyone is weary of this strange and unique year, but I do believe we've seen a point of inflection, and now is the time to have conviction and intestinal fortitude to continue working through periods of time such as this and avoid the risk that comes with riding an emotional roller coaster.
Well, David, as always, thanks so much for joining us today. And for additional information, David may be reached through the means listed upon the following screen. For the Trustful Tribune, I'm Brandon Dawkins.
David Guttery independently offers securities and investment advisory services through Ameritas Investment Company, LLC, member FINRA, SIPC, and Ameritas Advisory Services. Information provided in today's segment is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.